Welcome back, everybody. I'm Jeff Barton. This is the Mortgage Minute. We're on a number of social media outlets, LinkedIn, Facebook, YouTube, all these kind of places where this particular show, we have a weekend radio show that we broadcast 5 radio stations in 3 different states. Let's get right to it. Mortgage interest rates are going up, going to continue to go up. The Federal Open Market Committee meeting will be meeting next month with probably a 50 basis points rise in the short-term lending rate between banks. So not only is the Fed going to be raising rates once again and probably more aggressively to cure inflation, but we're also seeing rates rise on the basis of the 10-year yield rising. We have a number of items. Well, let's get to the rates. Let's just talk about that first. The 30-year fixed rate is at 4.84. The 15 is at 4.19. FHA is at 4.42, the jumbo is at 4.15, and 3.93 for the 5/1 ARM. As you can see, all of these rates have gone up by a point to 2 points over the last 18 months, 6 months really, and that's going to continue. The 2-year yield is at 2.42, and the 10-year yield is at 2.41. The dreaded inversion, the portending of future difficulties with the economy, i.e. it's a recession red flag. There are a number of conflicting opinions on that, but generally speaking, when we do have a recession, these particular yields on the bond invert. And that simply means that you can make more money putting it in the 2-year than you can on the 10-year. Now, why is that important? Because people are looking short-term because of inflation, because of the war. Obviously, the war is taking a lot more time and energy from the world's economy than it had been anticipated by either one side thinking it was going to be quick or the other side thinking it was going to take forever. We do see that there are repercussions within the economies of the world, whether it's trying to get chips made or trying to get wheat out. This is going to affect and continue to affect until we get some kind of peace resolution. Therefore, the volatility both in the stock market as well as the bond market is going to continue, which means that government debt being sold on the 10-year is probably going to have to raise too, meaning that the yield on the bond for the 10-year is going to rise, i.e. mortgage interest rates are going to rise. That's why we see almost 5%. We were predicting not 2.5 months ago, or at the beginning of January, that we would probably see 4% by the end of the year. Well, guess what? We blew by that pretty quickly. We've been very poor at predicting what's going to be happening both in rates and in the economy. Now, there are some people out there who are looking at what's happening in the real estate market saying, hey, look, there is a bubble here. The Fed, the Fed committee down in Dallas, the Dallas Fed committee, and I forget who chairs that, but they're really worried about it. And one of the reasons they're worried about it is because they're looking at what assets and how they are appreciating way beyond what multiples that you would be determining last year, 6 months ago, for what is happening in real estate, i.e. you have a supply and demand curve, absolutely, but these particular rises in the what houses cost are way beyond that. So if we're getting a 15 to 20% rise in houses, let's say in the Dallas area or in the Los Angeles or New York markets or even Boise or Sioux City, all of these areas, all of these metropolitan areas around the country have really seen, 10 to 15% increase, and they are increasing at an accelerated rate. Not a good thing, especially if you're a first-time home buyer. We've seen rates for first-time home buyers in the FHA world really rise very, very quickly. Not a good sign. Anyway, let's talk to you tomorrow. I'm Jeff Barton. This is the Mortgage Minute.